Hello, and welcome to the latest episode of ESG Talk, your go-to source for insights and advice for environment, social, and governance leaders. I'm your host, Mandi McReynolds. We are delighted to welcome to the show today Erin Bigley, Chief Responsibility Officer at AllianceBernstein, a global asset management firm. Erin oversees the firm's corporate social responsibility practice and is responsible for the investment strategy. This is why we're delighted to bring her to you as an expert integrating both. I think you'll find in the show that this has been instrumental for them to become a leader in responsible investing. And for those of you tackling this audience, you're going to have a couple takeaways too. So Erin, welcome to the show. It's great to have you.
Thank you so much for having me, Mandi. It's a pleasure to be here.
It's a delight to have you on. So let's dig in right there. Let's start talking about how do we define responsible investing? Is it just another word for sustainable investing, or is there more nuance to that? Help our audience understand this from your perspective.
I'm so glad you're starting there because I think that there can be so much ambiguity and confusion around the terms that we use to describe responsible investing and ESG and the whole ESG ecosystem. So the way that I think about it, I think about responsible investing as a broad umbrella that we use to encompass a whole spectrum of different ESG-oriented investment activities. The first of which would be ESG integration. And what we think of as ESG integration is the identification of material, that means financially material, environmental, social, and governance factors that can have some sort of impact on a company. And when you integrate ESG, you need to think about, can those factors impact a company's margins, their cash flows, their cost of capital, their revenues? And if so, how is that impact priced in appropriately to that company's valuation, whether that be their stock price or potentially their bond valuation? And we think this kind of comprehensive assessment of investment risks and opportunities really just brings a fuller picture. It really sharpens a manager's view on the overall assessment of a particular company or particular investment. So let me give you an example. So for example, think about a company, an industrial company, and it has a factory, and that factory emits carbon. There are several different material climate risks that you need to be thinking about in assessing that company. We could start with the physical risks. First, let's think about where that factory may be located. Is it located in an area that might be susceptible to sea level rise, for example? Or perhaps it's going to be in an area that's going to be hard hit by the increased number of hurricanes expected. Those are all material factors that might influence the need to do some sort of mitigation activities, that you might need to consider some impairment, or you might need to budget for continuing repairs. Then you can also think about material transition risks. So is the company in a jurisdiction where carbon is taxed, or could it be taxed in the future? You might want to think about incorporating some sort of estimate based on probabilities of that potential tax. You also might want to think about the potential for competitors who could be launching products that have a lower reliance on carbon, who could take away market share. So these are all factors that could potentially be material and impact that company that you then need to think about. How might they influence the way I view how this company is evaluated? And that might then influence how I want to position my portfolio relative to that company.
I think that was a beautiful way to unpack it and making it practical from the other lens of how does this relate to ESG and to those in the different industries. And one thing that I share with individuals is, number one, go find out what funds you're in that use ESG screens versus integration, and what is their methodology. right? Because if you don't even know the basis, you're just throwing things at the wall.
That's right. And you bring up the second key part of ESG investing that could be under the umbrella, which is more ESG focused strategies. So ESG integration is incorporating material factors across your investment process, whereas ESG focused strategies will think about some investing with some sort of ESG theme or focus in addition to their financial risk and return goals. That might mean using an investment universe of companies who offer products and services that generate revenue that is aligned with the Sustainable Development Goals, the UN SDGs. Or it might be investing in companies who are using diversity, equity, and inclusion as a competitive advantage. Sustainable investing, I would include in this type of investing, the ESG focused types of strategies. And to your point, I think it's really important to know where an investor might fall along that spectrum in terms of what are they seeking. To me, ESG integration is all about materiality. And I think there's not many investors who wouldn't want to incorporate material ESG factors into their process. But ESG focused strategies are not for everyone, just like investing in small cap stocks might not be for everyone, or investing in emerging markets might not be for everyone. ESG focused strategies may not be for everyone, and that's okay. Everyone has different asset allocation needs.
And one, tip too, as you look at the funds that you're in and the growth, it also could tell you as you look at new fund growth or new investor growth, where might you think about your strategy? And as you do investor interviews, one tip is to ask the question, think about it from that lens. Or do you view our company as a risk company or an opportunity company? What other theme-based funds do you have where you evaluate companies or integration? And so it allows you to have a more cohesive conversation with the investor as a stakeholder. I loved that you wrote about responsible investing has reached its adolescence, but without its growing pains. I thought that was a beautiful description, having grown up a little bit more in the financial service industry too, to talk about how responsible investing has matured over the course of time and some of the more recent challenges it has faced. Can you tell us more about, from your perspective, what are those challenges?
Sure. And I would start by saying I think that responsible investing is still relatively young. If you think about the PRI, the UN Principles of Responsible Investing, this is an organization that is sponsored by the UN, and it encourages investors to employ responsible investing, to consider these material factors when it comes to return and risk. It's less than 20 years old. So that's relatively young in the span of overall investing history. And I would say in recent years, the momentum behind responsible investing has been high. It's grown pretty meaningfully. The PRI in those less than 20 years has now accumulated more than 5,000 signatories, representing more than 120 trillion in assets under management. So there's been quite a bit of growth there. But yes, over the past year, responsible investing has had a pretty challenging past year. First, there's been quite a bit of regulatory scrutiny. And I think naturally, as the interest from clients grew around responsible investing, investment managers responded and launched strategies that were either ESG integrated or ESG focused. And investors were touting that ESG nature of their investment strategies. And most of these efforts, many of these efforts are genuine, but there is a risk that some firms' practices may be inconsistent with their statements. And that's what's commonly known as greenwashing. And so for the past couple of years, we've seen a surge in regulations that are designed to combat greenwashing. And while these regulations differ from region to region, at the end of the day, they've got a common goal, which is to make sure that asset managers are doing what they say they're doing, to be fully transparent about it as well. And that means we need to clearly state what our ESG processes and objectives are. Make sure that we develop rigorous and dependable frameworks to support those practices and objectives, and then report to our clients on those processes and objectives. I think there's a second challenge in the past year or so, which has been the underperformance of some ESG-focused strategies. Now, ESG-themed portfolios in the lead up to last year had actually performed, many of them, quite well. Many had investments in growth stocks, large cap growth stocks, which had performed quite well. But in 2022, you saw the underperformance of technology stocks and the outperformance of fossil fuel related companies. And so many ESG themed growth oriented portfolios underperformed. To us, that indicates that you need to develop complementary ESG focused strategies, meaning you cannot have just one type of style, a single investment style in your ESG focused portfolios. Just like any investment asset allocation, you need to have a diversified style mix of equities as well as fixed income and potentially alternatives based on your own individual situation. And so I think that the advice that you would give about traditional asset allocation rings true in ESG focused allocation as well. But what I would say is that I think that these ESG challenges, they're very natural. They're natural phase in what has been a pretty meaningful paradigm shift. And when you have these rapid shifts, they often come with some unsettling periods. And we would welcome them, as I said, as a sign that responsible investing is coming of age and growing up, if you will, but not going away.
Well, and I think it comes back to what are the priorities of your organization as you think about your investment strategy. I was talking with somebody about this topic, especially as you look at foundations who have a 5% return mandate in some areas that they may operate in the world, and that's fiscally responsible for the long haul. And I think you said it exactly right. It's about the risk, the opportunities, and cost. What are you willing to think about from volatility side of things? And it may be a transition or multiple strategies as you look at your holistic portfolio with your asset manager to accomplish both the financial opportunity as well as the risk and the volatility controls and the impact. And it's a journey for people. Just as the market is going through the journey, I think the consumers and those that want to align some of their value strategies in their assets have to go on that journey with people as we're all learning. Now, interesting enough, go ahead.
We always say ESG is a journey. It's right. Music to my ears because that's very much how we describe ESG and responsible investing at AB.
Yeah. And as you think about it, E, S, and G are all on this journey too, right? They're not all hitting it at the same time. Governance, especially in asset management, has been a long-standing piece that asset managers and investors have reviewed companies on. I want to pay a little bit of attention here to the S topic. We had Alex Edmonds on, who is a financial professor from London Business School, and we were talking about growing the pie. And we talked a little bit about S as an issue and its impact on operations and impact from the investor standpoint. What's your experience like around this S topic, and how should we be thinking about it?
Yeah, I would agree that there seems to be more interest in the S recently. For example, I was at the PRI conference in Barcelona in December, and it struck me that there was a real balance between the environmental topics discussed and the social topics discussed. It was not just about climate, which you may see in some similar forums. And we know that whether it is modern slavery or female representation in the workforce, companies are facing a growing list of social concerns. And social issues actually represent a higher proportion of corporate controversies rather than environmental or governance controversies. For example, if you look at the MSCI All Country World Index, as of January, roughly 13% of companies in that index were involved in some sort of severe or very severe controversy, compared with about 5% involved in environmental controversies and about 2% involved in governance controversies. Yes, so there's a significant number of social controversies, yet social factors seem to be less well incorporated into investors' investment processes. And I think one of the reasons for that is a dearth of quality and accessible data around social factors and the consistency or broad breadth of that data. So if you think about the environmental side and climate risks, you've got a carbon footprint. You have one number that you can use to assess. Now, that's not the end all be all. We could have a whole other podcast about that, but you can distill climate risks into single metrics over your portfolio. But given the heterogeneous nature of social risks and social opportunities, the fact that they differ pretty meaningfully by sector, there's no social footprint. So if you think about the apparel industry, for example, there you might really want to focus on the existence of forced labor. But if you then shift to retail banking, you're going to want to think about consumer protections. You're going to want to think about privacy. You're going to want to think about in the food and beverage industry, for example, you want to think about quality and the potential for recall. So there's different factors that impact different industries. What I would say is these are all likely to experience a bit more prominence because some of the official steps that you're seeing being taken around S factors. So if you take forced labor and human rights, for example, in the years between 2011 and 2022, we saw more than 20 different actions by governments and quasi-governments. So things like legislation or parliamentary inquiries or proposed guidance. And this wave of government legislation and other actions, we do think that that's going to incentivize companies to carry out and report on more due diligence in their operations and in their supply chains. You're already seeing government bans on products made with forced labor underway in the United States, and that's soon going to be coming to the European Union.
As we unpack that responsibility, I think building on what you said, and one thing that I think is surprising in the market is as we watch double materiality roll out in Europe, it is about what you just talked about, this collide between the financial impact and the societal impact, and how companies are going to get clearer on the measurement of those two things, how they're going to get clearer on how they disclose it that is comparable across industries. I think this is going to be the future, and we'll certainly have to unpack it in other shows about this collide of societal impact and financial impact. And as we talk with CFOs and as we talk with global companies, we're seeing them go on a deep dive, 2-year, 18-month journey to really suss out what those impact collides look like. And I think that's a bright hope for the asset management and investor community is we might end up with some more comparables in the S. So that's kind of my surprise, I think, from this perspective of 2023. I'm curious, what's your surprise?
Ooh, my surprise. I think that one thing I would suggest that's surprising or that we may be surprised by, but don't necessarily need to worry so much about, is that you're going to see more headlines about S issues, but you don't necessarily need to see that as a bad thing. So, for example, when I think about modern slavery and forced labor, what's key is how you're managing these risks. And we've done a lot of work about how to talk to companies about identifying these risks and managing these risks. And while it's sometimes unsettling when you see allegations or identifications of some of these violations or some of these situations of modern slavery or forced labor within a company's operations or their supply chain, we actually might view that as an important step, because if you're not identifying these risks, then you can't manage them. And so I actually think while it's may be surprising to some that you're seeing more and more of these social concerns and issues in the headlines, it can actually be a good thing, an important thing at this point in the life cycle of social factor risk identification and management. And we may actually see more of these types of headlines and identifications before we can actually see fewer of them in the future.
Erin, thank you so much for joining us today. I appreciate how you, with transparency and candor, pulled back the curtain on the investor community and asset management as they grow through the evolution of adolescence with environment, social, and governance. You helped us think deeper about how we approach our investor audience, and more importantly, what might surprise us as we head into tackling the S together. And to our audience, thank you so much for joining another episode of ESG Talk, brought to you by Workiva, the world's only unified platform for financial reporting, ESG, audit, and risk. If you enjoyed this episode, the greatest compliment we can receive is if you rate the show and tell us what you think on Apple Podcast. And subscribe to see future episodes on Apple, Spotify, or YouTube. Remember, you shape the show, so every comment counts. We'll talk real soon.